All right, let's get back to the markets. We are officially underway in the Tuesday session. We talked a little bit about the weakness that we've seen. A weaker than expected outlook from Oracle is currently weighing on the S&P 500. The TSX is a touch stronger. It's kind of interesting, that tech theme that was so dominant in the first half of this year, but that sector has been generally lackluster in the second half. So for the S&P 500, that nets out to fairly flat performance since the end of June. By comparison, the Canadian market, as measured through the TSX, has had some somewhat lackluster second half performance outside of energy stocks. But remember, the first half was not that strong. Certainly not as strong as the U.S. due to the smaller influence of tech in this country. So that nets out to year-to-date gains of around 4% for the Canadian market, compared to around 17% stateside. For more on how the fall story could play out in the markets, we're joined by Derek Massey, head of portfolio management at HSBC Asset Management Canada. Nice to see you.
Nice to see you.
What's your prediction for the fall here?
Yeah, I think we're in a point right now where central banks are dominating the news cycle. So the central banks are trying to balance slowing the economy and trying to tackle inflation at the same time, and that's going to provide some choppy markets. And I think we've started to see that through the course of, are we at the point of peak interest rate cycle or not? And I think that's what investors are focused on right now.
What do you think? Do you think rates have peaked?
I think we're getting very close. If we have one more rate increase or not, I think what the general theme that we're focused on is the fact that rates are getting very close to the top. And I think the central banks are going to be very quick to act if a recession does take hold. That dovish stance seems to be present a little bit, certainly with the Bank of Canada. And I think as we get through the better part of next year, we could be looking at some rate cuts, which should be beneficial for both stocks and for bonds.
Yeah, I was going to ask you, how are you positioning then if you think we've sort of hit the peak?
Right. I think the narrative last year, which I always thought was quite difficult, was the multi-asset or the balanced portfolio is dead, because we had 1 year where both stocks and bonds dropped. And I think it made an excellent opportunity to start investing in the bond market. We're starting to see yield in bonds, which is something I probably need to say more and more often to investors. We're starting to see some yield in bonds, which is a great opportunity for investors over the course of the next few months to start to pick up some fixed income and balance your portfolio out. Again, I listened to the narrative this morning about tech stocks and the big drop in a couple of the names. That's sort of what you get with high multiple equities. They've done fantastically well, but I think it's a great opportunity to start balancing out your portfolio. And fixed income offers, I think, what can be very decent returns with very low risk in this interest rate environment. And
I guess based on your argument, the yields that you can get right now, you won't necessarily be able to get, let's say, in a year's time.
Absolutely, absolutely. Yeah. It's always, if you're investing from a rear view mirror type of focus, where everyone's chasing that 5% GIC, well, what happens when that GIC matures in a year's time? And would there be a better opportunity in other markets? And I think fixed income with a slightly more aggressive risk profile to get away from a guaranteed investment into some fixed income makes a lot of sense for investors right now.
Okay, and then you made some comments about tech there. So would you be leaning away, let's say, from technology stocks that have outperformed this year in the equity world?
We've got a number of different investment products at HSBC, and some are certainly focused towards technology. But if we look at a top-down scenario where we're looking at country risk first and foremost, and looking at the U.S. being dominated primarily by technology, we're a little neutral towards technology. And if we look at country risk, Canada looks really strong with regards to quite cheap valuations. And as you said, the Canadian equity market has lagged a lot this year. So we're looking at really good opportunities with Canadian equities. We're slightly overweight Canadian equities. And again, balancing that portfolio out, looking at the yields that we can get in fixed income. So I think a balanced portfolio is a great opportunity for investors to take a little bit more risk and generate some decent returns over the course of the next couple of years.
Are there any parts of the Canadian complex that give you that desire to be overweight. Like we got energy stocks, we got bank stocks, you got material stocks. You've covered the lion's share of the weighting within the TSX with those three groups.
Right. Those are the building blocks of an economy. So if we start to slow down and the central banks start to react quite nicely, you look at what I think on the energy space, energy executives have got some sort of religion, so to speak, where they are now treating investors with some significant care, with share buybacks, with significant dividend payments as well. And it's not just drilling another hole in the ground, so to speak. So I think the energy complex looks quite cheap from a valuation standpoint, and some of the industrials as well. And looking at the Canadian banks, you know, after a pretty lackluster run in Canadian banks, we've got exceptional yields that those Canadian bank stocks are offering. So if you had a longer window of, say, 3 to 5 years, I think it's a really good opportunity to start to look at some of those sectors.
I guess the more bearish case I often hear from guests on financials or Canadian banks is that there could be some profit pressure if you have to consistently set aside money for bad loans, and if the economy does turn down, can you get loan growth, which is also something you hope for when rates are higher, that you keep the loan growth going and then you benefit from some of those interest spreads.
Right, absolutely. It's certainly not smooth sailing. As again, our theme is choppy waters going forward. Yeah. And I think given a little time, I think I'm quite comfortable owning Canadian bank stocks, given the multiples, given, quite frankly, the lack of competition here in Canada. And yeah, those dividend yields are there to stay. So if you can be patient with the dividend yields and smooth through some of those choppy waters, because I think the banks, for the most part here in Canada, are very conservative. So they will have loan loss provisions that they'll probably have to claw back as we go through the next couple of years. Again, making sure their loan books are solid is first and foremost in their minds. They're not chasing growth for chasing growth. And I think that makes a really good case that the balance sheets are pretty clean. And if you're an investor in those types of companies over the course of the next few years, I think you're going to do quite well.
All right. Well,